Good afternoon. Welcome to the TheoTrade evening video for March 6, 2023. I am Blake Young, and today we're going to be talking about Powell's prep takes the charge out of the bulls. We're going to look in detail a little bit about preparing for 2 days of testimony from Jerome Powell, the Fed chair. We had some interesting shifts and moves in the market based off of Bostic's comments last week. We saw the reversal and turn right back up. Now that reversal wasn't at a random place. You can see that it was where this bears and the bulls fought it out, and that's where we bought. You can see there's a big bearish candle, there's a big bullish candle. So if we were to look at that candle through there, this area would be an area that we could see some balance and some recovery and growth. Well, up here is where we can also see some failure, up near 4,100. So we're stuck kind of in the range, looking for a low near 3,900, a high near 4,100. And as much as we tried to push and push and push this bullish move higher and higher and higher, well, by the end of the day, the bulls ran out of steam. They lost their charge, and they pulled back, falling all the way back to fill the gap. We're somewhere between yesterday's close and today's open, and that's where we settled in. No real win, no real losers, just no more bulls, but the bears haven't woken up and decided to take control. To me, this is interesting because this move also seems unfounded then. If we're nervous about the Fed, do we really think that the Fed is going to take a different stance because of one bank president? One bank president says that they're going to stop at 25 basis points for March, and says that we may pause in the summer. So that move pushes us all the way up through here and then pulls us back as we're saying, well, maybe that wasn't founded. If we get more hawkish comments from the Fed, we may see it erase both of these days, Thursday and Friday, of bullishness. We could see a return back to that 3,900 range. Now, one of the things I want to look at is historic rate hikes. Historic rate hikes in comparison to what we're seeing in this chart. And to do that, I quickly created a document here, an Excel graph, showing the interest rates. We're at ZIRP back here in pre-2015, 2014. We raised rates to 50 basis points, or somewhere between a quarter and 50 basis points. And then we see the rallies. We see the rate hikes climb up and flatten out in 2018. And then we pull back sharply, and we had a surprise rate cut here in March. We actually dropped it to about I think if I remember right, 1%, 1.25%, and then we slammed it all the way down and got ZIRP again. But notice as I have this, I'm trying to line this up the best I can. From March until March, those 2 years when we had ZIRP again is when we did this, the fastest growth we'd seen in years. We're not even talking about the rate of speed when we were seeing growth here, because we had growth with higher interest rates. That's okay. That's normal. We can expect that. But ZIRP, zero interest rate policy, again, after raising rates and suddenly slashing them, surprise slashing, made money cheap, made money free. And when that money was free, we drove it all the way back up here. The question is, if we see rates stay up here at 5%, go to 5.5%, 5.5% to 6% maybe by summer, could we see a return back to what would be a sustainable growth rate and a pattern that's going to bring us back into the 3,000, even 2,600? And looking at history, that seems to make sense. We're seeing the rate hikes. We're now all the way up near 5%. We're approaching 5% for this next month's rate hike. And if we look back to each time that we raised rates before, that was followed by a drop in the markets. When we raised rates, it was followed by a drop in the markets. When we raised rates through here, we did pull back here. And there's generally a little bit that's priced in ahead of the rate hike because we expect it, and then the rest of it's priced in after they actually make it happen, when the rates change and it costs more to borrow. So if we see this move through here, if we see that go from February's rate to March's rate, and we climb another quarter point, even more so, if we climb a 50 basis points, that's what I've got priced in here, then I would expect us to at least drop back down to 3,900, and we could clear that. Not for next week. I'm not worried about next week. I'm looking out to the Fed decision on March 22nd. But tomorrow's comments could be a catalyst to push us through this low. And if I'm just looking at these last 2 months, we've done nothing. We've netted out no change. If we go all the way back, realistically, we have not changed price since last May. So even though we rallied on that zero interest rate policy, we peaked out and we started pulling back at the same point we started raising rates. February, March, and April of 2022, we started raising rates again. We found the top of the market, and we have been in a downturn and a pullback as long as we're raising those rates. And again, from the close price of April, the beginning of May of last year, we're now at an entire year where the market has not really moved. Another rate hike should bring us back to the next level, and we could probably see 3,800. 50 basis points could bring us to 3,800. Another rate hike in early summer could bring us back down to 3,500. And by the time we do hit the expected pause, and I say that in air quotes because I don't know if we're going to pause, and Jerome Powell has said he has no intention of pausing. There's no discussion of pausing. Why is it that Bostic is saying there's going to be a pause when Jerome Powell said there's no discussion of it? So if that's the case, and Jerome Powell over the next 2 days gives us that confirmation that there's no expectation of rate pause, then we fall back to the 3,800. And if we hit 6%, 6.5% by September, then we could see rates at a point they haven't been in decades, and we could see the market pull back and probably find this 3,200 or even 3,000 as the next support level. As a side note, the last time we were over 6% at the Fed funds rate level was back in 2000 and 2001 at the absolute peak of the dot-com super bubble. So the TNX, you can see back through here, was also above 6%. 10-year treasuries were above 6% and high as 7%. But the Fed funds rate was also above 6% back then, and we created an inverted yield curve then too. So there's a lot of room to grow before we even straighten out this yield curve, and we could see the 10-year treasury rates not just go from 4%, but could go past 6 and 7% just to catch up with the Fed funds rate by July, August, September. Taking a look at the CME's Fed Watch tool, you'll see that the market may be pricing in 25 basis points in a pause, but the CME's Fed Watch tool, which is pretty accurate, and it matches about 90% of the time what the Fed does. You can see that we're still pricing in 25 basis points with a 70% certainty, but we are pricing in higher rate hikes. We're still pricing in a 30% chance of that full 50 basis point. Now it can be in between those two, but the bigger part of it is that pause, the discussion of a pause. So if we're going to go from March between 475 and 5, and we see out into May, we're now 5, 5.25. June, we're 5.25 to 5.5, and yes, there's a little bit of chance of a pause there. But then July, we're also 5.5, and now heading to 6. September, we're not only still stuck here at the 5.5 to 6. I would say, do we call that a pause, or do we notice the fact that we're pricing in 6.25 and possibly 6.5 by September? So I don't know how much of that idea of a pause that we're really pricing in when we're still seeing more priced into future higher rate hikes. Now by November, we're not adding to the higher rate hikes. December, we're not adding to that. So maybe by fall, we price in a pause, but I wouldn't say that it's a very strong pricing in of a pause in the summertime, June or July. And if that's the case, we are still seeing a terminal rate for the Fed, not just 5%, but over 6%. As a potential now. So we could be seeing 6% rates here, and a 6% rate from the Fed could mean a 7% or higher for the 10-year treasury, which would entail mortgages at 8.5 to 9%, commercial loans at 9 to 10% if we see the 10-year treasury get that high. And one of the last things I want to highlight as we go into the Fed speech, which could give us more indication whether it's 25 or 50 basis points, whether there's a pause or no pause, is how directly those treasury rates hit those that borrow. If we look at XHB is the home builders, and we can use ITB as well, and we look at the correlation study. The correlation study, I have 10-year treasury yields up top and the home builders down here. If we look over the last couple of years, and this is the weekly chart, we could do it to the daily if you wanted to, but we're looking at 3 years. And if we look at the amount of time that we have an inverse correlation, that inverse correlation tells us that as rates are rising, 10-year treasury is rising, then we should see home builders falling. It's a negative or an inverse relationship, 50 to 75% for the last couple of years. During 20 2021 when rates were not moving, then it wasn't that big of a deal. But it was as the rate started changing and we start seeing the 10-year Treasury climb that this starts to have an impact. And we have that inverse correlation kick back in. Let's take a look at ITB instead of XHB. ITB is a little more tied directly to home builders and not including things like Home Depot, Lowe's, and Sherwin-Williams as much. So we have ITB, and you can see that same inverse correlation. If we were to come down here, we need to see 1 and -1. And you'll see that if we focus in on that 1 and -1 here and focus on just the last 3 years, the inverse correlation below 0, the majority of the time, yields rising means weakness for the home builders. Yields falling means strength for the home builders. So that inverse correlation has decoupled after a year and a half of being the same, 2 years of being the same. And so if you see this roll back down, if you see the correlation drop back sub-0, and you see the 10-year treasuries rise past 4%, and especially if it gets past 4.3, then we should expect home builders to fall and probably fall quickly. And we could also do the same correlation with yields and tech stocks. And here's comparing yields to the XLK or the tech sector. And again, you'll see the same inverse correlation because tech stocks have a tendency, or tech companies have a tendency to borrow quite a bit. And as a little side note, just a reminder, the only time that we were really decoupled from that high correlation or high inverse correlation, meaning rising rates hurt tech companies, rising rates hurt home builders, the only time that was not the case is back here when we were dealing with ZIRP, zero interest rate policy. We were sub 1%. This is 1%, 1.5, 2.5, 3. So back here when we were sub 1%, in essence, it's a zero interest rate policy on the 10-year treasury, that's the only time that it decoupled because 0 is 0, 0.2 is 0.2, 0.5. It's super cheap. And so since it's very cheap to borrow, then the correlation between rates moving by a quarter point or half a basis point compared to the tech stocks or to home builders really didn't matter. But after we started raising rates again, after we started pushing to these new highs, that's when that inverse correlation got back into play. So it's something to watch. All of it comes down to what Jerome Powell says. We're going to price in some expectations based off what he says over the next 2 days, but then we'll price in part of that, giving us time to act, react, and then we should have the rest of the time to act and react after March 22nd when the rate hike truly comes out and we see what the end result is. So thanks for watching, everybody. Have a great week. We'll look forward to talking to you next week, same time. And we will wait to see what Jerome Powell has to tell us over the next 2 days. Take care.